Here we are going to discuss about the role of closing entries in the accounting cycle. Position in the accounting cycle. Closing entries are the last step in the accounting cycle following the preparation of financial statements. After closing entries, the company can begin a new accounting period with the temporary accounts like revenues, expenses, and dividends reset to zero. Steps of the accounting cycle: analyze transactions, journalize transactions, post to ledger accounts, prepare trial balance, adjust entries, prepare financial statements, make closing entries for closing trial balance. The completion of closing allows for a clear transition to the next accounting period, ensuring that the new period's financial performance is measured without any distractions from the previous period's balance. The next is forgetting to close all temporary accounts. Not all revenue and expense accounts are closed properly, leading to incorrect balances in the following period. Incorrect transfer to retained earnings. Failed to account for the net income or loss correctly, resulting in an inaccurate retained earnings balance. Not closing dividends. Dividends must be closer to retained earnings, but sometimes they are overlooked, which distorts equity. Avoiding these mistakes, a clear checklist of all temporary accounts to close can ensure to accounts if it is missed in the process. The next is post-closing trial balance. After closing entries are made, a post-closing trial balance is prepared to ensure that debits and credits are still balanced and that only permanent account balances like assets, liabilities, and equity remains. Purpose of the post-closing trial balance: verifies that all temporary accounts have been closed, confirms the equality of debits and credits after closing entries, ensures the accuracy of financial statements and balances carried into the next accounting period. A merchandise company's post closing trial balance includes only accounts such as accounts receivable, inventory, accounts payable, and retained earnings. The next one is benefits of closing entries for merchandising operations. Accurate financial records. Closing entries ensure accurate financial reporting by properly reflecting revenues and expenses in the correct periods. Supports decision making with clear and accurate financial data. After closing entries, businesses owners and managers can make better informed decisions, recording inventory pricing and sales strategies. Prepares for auditing and compliance. Proper closing entries facilitate a smoother audit process by ensuring the financial records are in order and meet regulatory requirements. Clear division of financial periods. Closing entries clearly demarcate financial periods. The company to evaluate performance on monthly, quarterly, or annual basis. Um, the next is practical application of closing entries in software. Automated systems. Many accounting software systems such as QuickBooks or SAP automate the process of making closing entries. However, it's essential to understand the underlying process to ensure proper setup and oversight. Software features. Systems automatically reset revenue and expense accounts at the end of the each period. The user input net income and software update retained earnings accordingly. Manual versus automated. Manual system require businesses to manually prepare closing entries, which can prone to error. Um, Software systems reduce errors but require accurate setup and initial understanding of accounts are mapped and closed. Special considerations in merchandising operations. Inventory adjustments before closing. Merchandising companies often need to make inventory adjustments for shrinkage, theft, or spoilage before finalizing closing entries to ensure the accuracy of COGS. Multi-store operations for companies operating multiple stores or locations, consolidating revenues and expenses from all locations before making closing entries ensures accurate financial reporting. Seasonality and closing. Merchandising operations often deal with the seasonality in closing entries, help differentiate between high and low periods, making it analyze trends, forecast future performance. Next one is revenue and expense account. Show before and after sales of states of revenue and expense accounts to demonstrate how they go from holding balances to zero after the closing entries. Examples of retained earnings show a simplified balance sheet where retained earnings are updated after the closing entries have transformed the net income or loss. Visualization: before closing entries, revenue equal to 50,000, expense equal to 40,000, income summary equal to 0, retained earnings equal to 10,000. Closing entries are essential for resetting temporary accounts to zero and updating the retained earnings with net income or loss. This process ensures accurate financial reporting, reflects true business performance, and prepares the company for the next accounting period. Properly executed closing entries maintain financial integrity and support